no discussion of merchandising companies would be complete without reminding you about the changes that are going to happen as a result to the closing process and the adjustment process associated with when we have inventory involved with a business. And so that's what this video is about, is the necessary adjustments and closing entries, the changes to the closing entries that happen as a result of being in, a result of us having inventory. So, one of the adjustments, remember that the perpetual system, we're constantly updating the inventory and cost of goods sold as we record sales and purchases, transactions. So we buy stuff and the inventory goes up, and we sell stuff and the inventory goes down. When the inventory goes down, we transfer that cost to the cost of goods sold. But occasionally, the value of the inventory changes not because we sold it, but because things wandered off. And it may be because they were just lost, misplaced, became damaged, we threw them out. Lots of reasons for doing that. And of course, in a retail environment, it's not uncommon to have a certain degree of theft. And all these things are considered to be shrinkage, that when you have inventory, you run the risk of some of it just wandering away. Sometimes it's just a problem with record keeping, but regardless of what the reason is, we need to bring the balance in the inventory account that tells us the value of the goods that we currently own. We need to get that right every once in a while and confirm that we actually have the right number. And we do that by actually doing a physical count. I want to remind you that, remember the idea that as the costs accumulate, they go one of two places. They're either the cost of the goods sold or we still have it. So as we're checking in a perpetual inventory environment, if we discover that we no longer have the merchandise, we have to make the assumption that it becomes part of our cost of goods sold. We might not have actually sold it, but that's where we record the cost. So here's a little example. When we check the general ledger account, it says we have $21,250 worth of inventory, but when we actually counted it and valued it all up, it turns out there's only $21,000 worth of stuff. And so we have a difference of $250. There's an adjustment required because that $21,250 is no longer correct. Like with most adjustments, we're trying to bring an incorrect number back to correctness, or at least more correct. And so we need to reduce that $21,250 in the accounting records down to $21,000. So that's going to require a credit to our merchandise inventory account of $250. When we post that transaction through, that $21,250 will get reduced to $21,000, which reflects how much was actually there when we counted it. The other side of the entry is cost of goods sold. The inventory is no longer here. It becomes part of our cost of goods sold. And that's how we compensate for the difference. So you may wonder what happens if we actually went out and counted and there was more than we actually thought there was, if those numbers were actually reversed. Well, then the entry would actually be reversed. We debit merchandise inventory for the value of the material, of the stuff that we actually found, and because it's still here, apparently we didn't sell it, we would actually credit the cost of goods sold. So that's the one adjustment that we make in a perpetual system, just to bring the general ledger account back in line with what we know to be reality when we actually count the goods. Let's talk a little bit about the closing entries. In a perpetual system, it's not surprising, we have a few more accounts to close out. But really, we're still talking about the temporary accounts for a merchandising company. And where do those temporary accounts show up? Well, they're in the income statement. So all the revenues and expenses, all those accounts that show up on the income statement, all need to be zeroed out, just like any part of a closing process, the big reset. So those temporary accounts get zeroed out. And we have some new ones now. So they'll include, of course, sales. We may have had, it might be new to you that we were talking about revenues before, or those sorts of things. But that sales account, but in addition to that, we may have sales returns and allowances and sales discounts that also need to be zeroed out. If they appear on the income statement, it's a temporary account, it needs to be zeroed out. And that cost of goods sold account, remember, it was accumulating the cost of all the goods we sold this year. It needs to be zeroed out so we can start accumulating the cost of the goods we sell next year. Now, that's a periodic or a perpetual system. Periodic system has even more new accounts. I'm just going to show you a simple financial statement or income statement for a company that uses the periodic system. And we know they use the periodic system because of how they calculate cost of goods sold. They don't have just one number for the general ledger account. They've got the inventory at the beginning, plus the purchases, plus any freight charges, subtract off the returns and allowances, and that's the goods available for sale. So each one of these accounts, the beginning inventory, purchases, freight charges, returns and allowances, they've all got to be closed out and adjusted. And the ending inventory. Now this little closing entry that involves the ending inventory and the beginning inventory they're actually the same account. And we'll discuss in a little more detail in seminar the trick associated with that. But the goods available for sale is not a general ledger account, it's just a number we calculated. So it doesn't get hit with a closing entry. But each one of these accounts will actually get closed out and adjusted during the closing process. And the gross profit, again, is not a general ledger account, it's just a number that we calculate. And of course, all the operating expenses, I don't have them listed out here, but salaries, utilities, and all those sorts of things, they'll get closed out as you're used to with any other company. But the new accounts for a company that uses the periodic system, all those freight charges and purchases, and for a periodic, it would just be the cost of goods sold account. A good way to practice this, exercise 612, QS 613 and 618, and if you're still struggling, take another look at lyrics 6.4 to 6.7. It covers off everything associated with making adjustments and doing transactions in companies that have periodic perpetual systems, and as well as calculating the gross profit and cost of goods sold for companies using periodic and perpetual systems. So good practice all around.